This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, today's show is a really exciting one. I've been looking forward to this all week long because we have as our guest today the man who literally wrote the book on syndication. And this guy is just amazing, and somebody that I have just I feel very honored to be able to have as a guest on the show. His name is Samuel K. Freshman. He's the chairman of the board of Standard Management Company, which performs real estate acquisitions, bridge finance, and property management. He has been active in real estate investment for 60 years as an attorney and investor. He has been an expert witness in real estate, legal matters, finance, has been a lecturer at Stanford Law and Business Schools, chairman of a bank, title company, and a theater exhibitor. Chairman Emeritus, Stanford Professionals in the Real Estate, SPIRE, or SPIRE, author of books and over 20 published articles. Mr. Freshman has developed a book series on saving entitled The Smartest Way to Save, The Smartest Way to Save More, and The Smartest Way to Save Big, about becoming rich on a modest income. Sam received both a BA degree, pre-legal, in 1954 and a JD, 1956, from Stanford University. Whoa, what a background. Sam, welcome to the Old Dogs REI Network.
Well, I'm happy to be here.
Well, we're really glad to have you here, and we just think that your knowledge and experience and wisdom is going to be a real value for our listeners, all of which who are very interested in real estate investing and syndication. So maybe you could just give me a little background how you got involved as a real estate investor, which you're also active in, as well as an attorney that specializes in syndication.
Well, yes, I got started really on my dad's advice. I grew up in Michigan and decided, when you grow up in Michigan, you want to come to California. And there was a college night at one of the local high schools, and there was a recruiter from Stanford. And so he latched on to me, and I latched on to him, wanting to come to California. Nobody in my high school ever heard of Stanford. They thought it was in Connecticut.
I think that's Stamford with an M, right?
Right. So anyway, I came out here, went undergrad. I started pre-med, didn't like that. My dad said, look, we need a lawyer in the family. My dad hated lawyers and felt we needed one to protect us from other lawyers. And, so I switched to law. I loved it. graduated and said, Dad, I don't know what I should do, though. Should I be a tax lawyer, a litigator, a tort lawyer, etc.? Now, my dad had bought a factory out here about 2 weeks before I graduated law school. And without taking a moment's hesitation, he said, go into real estate. That's where all the money's made in California. So that's what I did. I became a real estate lawyer and then started investing on the side.
Now, was syndication fairly popular at that time, or was it a newer? I know you can syndicate other things besides real estate, but was it a very active area?
Not very active in real estate. It was very active in financing motion pictures, and probably I picked up a lot of ideas from that, being here in California and living in Beverly Hills. But it had been around for a long time, but really not promoted that much. And it was just sort of coming into its own, so to speak.
Well, before we get too much into syndication, what I wanted to find out is just from you, and again, his book that he wrote is called The Principles of Real Estate Syndication. What is syndication?
Well, syndication is where there's one party who goes out and finds the investment. And as you said, it could be anything. It could be making a film. It could be a business. But that person is responsible for running the enterprise. And another person puts up the money but does not participate in the management of the enterprise. And that creates what's called a security, where one person is investing and depending on the work of another. That's where the securities laws come in where a lot of the, let's say, the legal stuff gets involved. And there are rules about the relationship between the two, and when and where you have to register or qualify, and when they don't apply. But I'll leave that, because that's the subject of another hour conference.
Sure. What would make somebody want to syndicate? What's sort of the situation that says, this would be ideal because of this situation?
Well, what you're looking for, of course, is an investment where you can get enough of a return to keep your investor happy and leave something on the table for yourself. And syndication is similar to the role of financing, which is, of course, to leverage an investment. That is, borrow money at a lower rate than the investment's going to pay you back, which increases your return. So if you have $100,000, you can buy your own property. You don't have to deal with the laws. You don't have to consider anything else. And maybe you can make as much as, over time, 8 to 10% on it as the income grows. Or you can take that $100,000, go out and get 9 other people to invest with you, and you keep an override on the investment. And instead of making 10% on your money, because of the effective leverage, your return may be as much as 20 or 30%, or even more on your investment, by bringing in other people and getting a share of what they're making.
From my own personal experience, I have invested in starting with single family, went to multifamily, was able to buy a 22 unit just with my own income, but then now I'm looking at 100 plus units. And, just the cash required for that is really going to require outside investors. So I guess, I could joint venture with someone. I could, find a sponsor or other ways to do that. But syndication seems like probably the best way to do that.
Well, it depends, of course, on the project and your resources. And if you can raise money from a group of people, you can usually keep more than if you're just going to, say, your rich uncle at the golf course, who's probably a pretty sharp guy, and he'll give you a reasonable return, but probably may not be as much as you could make by syndicating it to a larger group.
Right. So if somebody makes that decision, syndication is really what I need to do, where do you start? I mean, there's so much involved here. There's investors, there's obviously the legal end of it, there's putting a team together. Where does one begin?
Well, that again depends on your resources and experience. In my case, I was fortunate in having a legal background, so I didn't need to look for an attorney. And I lived in an area where there were a lot of young doctors, and they all had money. And my wife would meet them at the park with the kids, and we'd invite them over for dinner or to play bridge or something. And so I started out with a lot of the resources, let's say, or the pieces there. Now, if you don't have that, then the best thing to do is find somebody that's in the business and partner with them till you get your own background and familiarity with it. And a lot of syndicators start out as lawyers or accountants or insurance brokers, and they have a pool of possible investors right off the bat, their clients. So if you don't have that, you may want to look around for somebody who needs, let's say, a gopher.
Mm-hmm.
Go to do the grunt work and get familiar with it and go to work for a syndicator. A lot of them start out. We probably have over 100 graduates here in the Los Angeles area that have started out with us over the last 60 years, and some of them have gone on to probably equal or exceed what I've been able to accomplish.
Wow.
So I would say for the average person, find a local person that's doing this and either go to work for them or ask them to mentor you to get you started, or partner. A lot of syndicators start out partnering with somebody that's already in the business. They've got an unusual opportunity. The key to syndication long range is finding the right product. The money part, the raising money part, becomes easy after a while. I know that sounds crazy, but it's much harder to find a good investment than it is to find investors.
That's great advice. Yeah, I would think that getting that syndication attorney would be a pretty important factor early on. At least from what I understand of syndication, you need to be very careful what you say to people that you may not know well, who may be potential investors. I think just being versed in the law and what you can and can't do is important.
Well, I don't want to, let's say, rain on my profession, but I would say that the lawyer comes rather late in the deal.
Oh, really? Okay.
Because, as I mentioned, the first thing you have to do is find a deal. I mean,
right.
You can talk to lawyers and accountants till the cows come home, but if you don't find a deal that is a good investment, you'll never get started, and you'll waste a lot of time. So I would learn first how to find a good deal, and then when you've identified something that you think is worthwhile, investigate that, and if you want to go ahead, then you go to the lawyer.
Oh, that's good. The only thing on that is, well, you only have so much time. Let's say you got a property under contract. You only have a limited time to find the investors, to get all the paperwork together and the filings and the due diligence and everything else. It seems like it becomes a lot more of a pressure move at that point.
Well, that's why I recommended that you start out with a partner.
Right.
Who probably knows 90% of what you're going to have to learn, and you can pick it up, all the practical aspects, pretty quick instead of running around town to lawyers, accountants, and others. There are lots of good books out there, not just mine, but others as well on the very aspects, and go to lectures and so on, which are offered in most major areas. There's a lot of free lectures where people are trying to sell, things to retired people. and you get them in the mail all the time. You're offered, come to dinner and hear about this deal or that deal. I think everybody who over 50 gets those.
As like a timeshare or something.
So go. It doesn't cost anything. Let the other guy give you dinner and tell you and see how he does it. And everybody does it a little differently. After you've been to a couple of those, you'll figure out how you want to, how you want to pitch your deal.
Right. If somebody wants to make the step into syndication, you have to know a few factors right off the bat in terms of how much you need to raise. What are some of the factors that you have to assess sort of right off the bat?
Well, the first thing you have to look at is what are the leverage opportunities when you're figuring out how you're going to finance the deal. For example, if interest rates are high, then you're going to have to probably raise a large part of it in equity. If interest rates are low, as they were up until a few months ago, then you could borrow as much as 75 to 80% of the cost of an apartment building. Today, it's more like 65%, and then you get into negative leverage, where the leverage is actually pulling down the return. You want to set up your financing where the leverage increases the return to the equity.
So in your putting together the syndication itself and determining what you're going to pay your investors, for example, if the interest rates are high, like you were saying, does that mean you would try to keep return lower for your investors?
No. It means you have negative leverage, which means the more that you borrow, just automatically the return is going to be less. If the rates are low, then the more you borrow, the higher the return is going to be on the amount you invest.
Gotcha. Somebody that's looking at syndication again, obviously a big part of that is getting investors. So what can you say about that part of it? Because let's say you don't have a property yet, but you want to start seeing who potentially could be an investor, how would you approach that if you really don't have anything tangible to hand them? So, for example, this is the deal. How would you address that?
Well, you look at your resources, and for example, there may be people that are in your social circle that are wealthy and have money to invest, or they may not. If you happen to be fortunate that you can do it with personal contacts, that's the easiest way, and you just ask them, would they be interested, and what sort of things are they interested in, what kind of returns are they used to getting. But if you have to start out from scratch and you're new in town, and your own crowd is all just barely making it, then you go out and you find a partner that has those resources and find out what he or she is looking for, and find her a property. And your first contribution is not the investors, it's the property. As I said, anybody that's been in this a long time and that's successful has more trouble finding property than in getting investors. Whereas we're always looking for property. We have a pool of 400 investors, after the 60 years. So it's always nice to have new ones. When you're in real estate, you never have enough money. There's always another deal down the road. But frankly, I would say 80 or 90% of the effort of our staff is in searching out for property. Only a small portion of our efforts go into raising money. Now there are investors like Wall Street and so on. That's their business, and they are primarily focused on the raising of the money. But of course, it's not their money that's getting invested. In this case, see, one of the first questions that your investor is going to ask you is how much of your own money are you putting in it? And if you're not prepared to invest anything in the property, don't go into this business. You got to first, that's why I wrote the books on savings, because so many people want to start out by jumping into it right away. I said, no, you've got to be able to have at least 10 to 20% of the equity yourself, or nobody's going to listen to you. However, if you don't have that, then get a partner that does. And you go out and find the property. You make your expertise and your resource the finding of the properties that your other partner who's got the money doesn't have the time for.
Right. That's good. Good advice. Aren't you going to have investors also saying, well, what kind of a return would I get if I'm going to invest with you in this syndication?
Well, you have to look at your farm. Everybody that's in the real estate business, has a farm, which means their area that they're going to farm for deals, and you see what the returns are. Obviously, if you live in Beverly Hills, the properties sell at a 2 or 3% return. So if they want more than that, if the investor wants more than that, you're not going to buy in your own neighborhood. You're going to have to look somewhere else, like we're buying in Nevada right now, because we can get 5% returns there versus 2% in Beverly Hills or 3% in Westwood, or the returns in California are much lower than they are in some of the other western states. So you may have to go quite a ways to meet your investors' needs. You never will find out unless you ask. So you ask them all these questions. First of all, are they looking? Are they interested? Your main resource is time. And so you don't spend a lot of time trying to talk somebody into this. They may say, well, I only buy bonds, or I only play the stock market. I'm not really interested in investment. Well, then move on. Now, some people love real estate and would like to own part of an apartment building, since you started in this, so you're familiar with that, and you've concentrated on building up a list. But as I say, if you can't find the list, that doesn't mean you can't play the game. You can find somebody else that has those contacts, and you perform the other end of the job, finding the deal.
Great. If somebody says that for example, that they're used to earning, I can do 10% or something like that, whether or not they're going to be a potential investor or not, right? I would
Right.
Yeah.
Yeah, whether if they're looking for 10, you're looking for a property that over time you could bring up to 12 or 14. So if there's some money left on the table, now generally our market is probably a 6% pref, let's say, to the investor. Some syndicators, they have to go as high as 10. So we have a much broader and can buy better quality properties at 6 than if we had to pay 10. The 10% ones are going to have a lot of risk, generally. But you determine what your market is, and that determines what you can buy.
Do you ever quote your annualized return or your IRR to potential investors?
Sure. Look, here's the thing. Everything is subject to change and volatility when you're dealing with investments. Someone will come to us and they'll say, where will we be in 3 years? So you're either an investor or a speculator. We are not speculators. Speculators are people that buy properties, fix and flip them, sell them within 3 to 5 years. Now, a lot of younger people want to see that action, and so they're not our customers. We want people that are looking at the long term, retired people that want to be very conservative and look at this as a source of income. So I can pretty well predict the income level. I can't predict the total profit, though, except in the long term. I would say, okay, we're going to buy this property now, and it's going to pay probably 5, 6, 7% at this point. Might be, normally I'd say 5, but we're going to, within 2 years, we'll have it up. In 3 years, we'll have it up to 6 or 7, and go on from there. However, as far as what it's worth, probably be worth less than we're paying for it now, because recessions come. I've been through 6 recessions. And the key to this is not to overborrow, because leverage is great on the way up, but it's disaster on the way down. I have friends that were worth $100 million and then they're wiped out in the recession because they borrowed too much. You want to be able to have a 20-30% drop in rents and still meet your mortgage. That's one of the tests we apply. You have to have your own set of what we call acid tests. Like, we will only buy in neighborhoods where the schools are rated 6 or better, 10 being the best. If the school rating is 2 or 3, we don't. It goes immediately in the wastebasket. We don't even need the whole office. We have a bunch of criteria like that, and you develop your own criteria of what you're looking for, and then you check against. Because again, we get back to your resources, primarily your time, if you're going to be the syndicator, and therefore you have to set up procedures and formulas and so on that will satisfy your investors and satisfy your needs, but that you can apply quickly to any proposed acquisition, so you don't waste a lot of time. A lot of people go into this and spend days, weeks, and months looking for things and never buy any.
Right.
They don't have a pre-established criteria.
Now, how long do you normally hold on to your properties?
Forever.
Oh, really? So you're going the long run on it. Okay.
Yeah, but you do have to have a projection. So we do a 10-year projection on the assumption that it would be sold in 10 years. Actually, our holding periods are more like 30 or 40 years. And I tell people, you're buying this for your grandchildren. It's not only for your retirement, but for your grandchildren. I've only made 2 mistakes. I didn't buy enough, and I sold too soon.
Can you say that again so we can? I didn't hear you as well. Really wise words.
The 2 biggest mistakes I made was I didn't buy enough. I could have bought more, and I sold too soon. I bought buildings for $1 million. I started with 1920s high-rise office buildings in downtown Los Angeles, and I buy them for $1 million or $2 million. The buildings would be vacant upstairs, 11 floors vacant. I paid almost nothing for the building. Sold them after maybe 3 to 5 years for $2 or $3 million, and we thought we were doing very, very well. Now, of course, this was 50 years ago. But today, those buildings are $100 million. And I should have done is kept 4 or 5 of the first ones I had. And not done this whole thing of buying and selling all the way through.
Wow. Well, what you kind of mentioned, sort of biggest mistake. What would you say what was your one biggest success that stands out above all of the others?
My biggest success was the Lakeside Apartments in Burbank, California. I bought them early in my career for $10 million with $100,000 down, but that's another story.
$10 million with $100,000 down?
Which I bought, and it was how I structured the financing. And again, that's I can't give you the whole 60 years experience in 1 hour. But anyway, I eventually sold part of that for it was 750 units and a shopping center, and I paid a total of $10 million. And within 5 or 6 years, 7 years, not too long, much later, I sold the apartments alone for $29 million, and I still have the shopping center, which is now worth $30 million.
Wow, unbelievable!
So but don't misunderstand. That doesn't happen very often. You may, in the course of your 60 years or whatever, make you do 1 or 2 of those, but you don't have to do too many of them.
Wow, that's a great story.
The usual, I would say the usual thing is that we'll make, say, a 6% cash return over average over the 10 years. Let's assume we sold at the end of 10 years, and we'll double our equity as well. That comes out to, by the way, about a 13% IRR. Anywhere from a low 10 to as high as a 13 or 14. If you're projecting more than that, there's probably a lot of risk or something you're missing.
Do you ever do sort of a cash out refi, or you pay off your investors, but you hold on to the property?
We don't do that.
You don't do that? Okay.
Oh, we try and get it down to where we don't owe anything. That takes about 20, 25 years.
Right.
And, so then the investors are happy and we're happy.
That's great. Well, we have a lot of investors listening and people that are very much interested in growing their real estate portfolio. What kind of advice would you give them in getting started out? They're later in life here. A lot of us starting out, we don't necessarily have the 20-year, 40-year, opportunity. So, what advice would you give them to get started in real estate investing?
Basically, what I've said is find out what your role is in this transaction. Are you going to be the guy that finds the property? Are you going to be the guy that manages the property? Are you going to be the guy that finds the investors? There's a lot of different roles here. Now, some people do everything, but if you do everything, then you're going to have to stick with smaller properties. But if you want to get into, let's say, the big game, you're going to have a specialty or expertise. Where are you most comfortable about? And what do they always say about working? You'll definitely be successful if you do something you like. So some people are green eyeshade guys that like to play with numbers, and so they should be more and dig into it and do the due diligence and that part of it. And a lot of people that I've seen that go out into this, they work in teams. Like I had the two guys that worked for me, and they finally left I threw them out about 17 years ago. I said, you guys are too smart. You should be out there on your own. And today they're each worth about $60 million. But one guy was great at running the properties, and the other guy was great at raising the money. And so it was a good teamwork. So you have to figure out where you want to be in this industry, and that's what you start with. You either get a job doing it, or getting a mentor, or getting a partner who can give you the benefit of their experience. I mean, you can get 60 years experience or 40 years experience by mentoring with somebody that has it, and then it's right there with your partner. And your question comes up, you just go into the room next door and he'll tell you what the answer is.
That's great advice. Well, you seem like you love what you do, Sam. I mean, I can just tell it when you talk about it, and reading your writing, it just seems like you have a real passion for it. I would imagine.
On that issue, I just want to say I've never worked a day in my life. I grew, when I was a kid, I played Monopoly every day, and I'm still playing.
I love it. Now it's Kiyosaki's what's it called? The cash flow game. It's like the new Monopoly game, right?
By the way, he has a lot of good ideas in his books.
Yes, yeah, he does.
I was looking at my list of quotes that he said, "What's your favorite quote?" And I saw that he was the only one that was on my list that had more than 3. And I think he was on there for 4 or 5.
Well, you probably, I'm sure, you could have retired a long time ago with the successes that you've had, but obviously that's probably the furthest thing from your mind. I don't know. But what really is the future? What do you see for the future of your business?
Well, I see change. The only constant is change. I started out with 1920s high-rise office buildings. Then I did distressed shopping, underperforming shopping centers, or shopping centers that I could do a lot of value add on. And then I went into apartments. And I started in the Los Angeles area. Then I went national. Now I'm focusing on Nevada. The business is constantly changing, and you have to try and be ahead of the pack. Like we went into Reno about 3 years ago, and we doubled our equity on those investments in 3 years, something that normally takes us 10 or more. But we just hit it right. We got in before the Tesla announcement because we knew that a lot of Silicon Valley companies were moving there, Amazon, Apple, and so on. And everybody thought Tesla was going to go to Texas. So did we. It turned out to be a lot better than we thought. It's like I bought an empty Kmart in Bakersfield a couple of years ago for $4 million, put $2 million in it, and sold it about 5 years later for 12. It's much better to be lucky than smart.
I like that. That's another great quote. Oh boy.
Well, I'll give you one more. So, because I went through the list, and this one really hit me. Always do right. This will gratify some and astonish the others. And that's Golda Meir, the former Prime Minister of Israel. So
that's
if you're always doing the right thing, you'll surprise a lot of people.
So for your business, have you set it up in such a way that you want it to continue to grow and nurture other managers within the team?
Yes, we're set up for down to my grandchildren.
Oh, that's great.
And then beyond that, I don't want to be trying to manage people's destiny beyond that, but these are the people that I know. I have people that have worked for me, some of them still here, for more than 30 years.
Wow.
I have two of our executives have been with us 32 years. My personal secretary has been here 18 years. Our administrative VP has been here 25 years. I would say about half our staff have been here over 10 years.
Gee whiz. That's pretty neat. Well, this is I could talk to you forever. This is a subject for me that's just fascinating, and I'm learning a lot as it is. And so just being able to talk to you and to hear your feedback and ideas is really valuable. But this is sort of the end of our podcast now, where I have our little wrap it up session where I ask you a series of quick questions and you give me, your quickest answers before we close out. So are you ready for that?
Sure.
All right. Favorite real estate book?
Well, Principles of Real Estate Syndication, of course. I know your next one is a favorite business book.
Right.
I would say the same thing. Anything about time management. Time is your most valuable resource. And I would consume anything that you could find about time management. All these books are based on what's called the Pareto Principle, which is 20% of your effort produces 80% of your results. So focus, first of all, study how you're spending your time now, where you're spending, just as like with a budget or something, and then shift as much as you can to that 20% that's producing 80% of your results. And you'll find that that's almost every book you read is just another method of following it.
That's a good point. A good point. What would you say your most valuable website for success is?
Too many out there.
Okay. This is going to be a tough one. I haven't gotten one answer. Oh, I did get your book on the best real estate book. How about do you use any apps on your phone or?
I have no apps on my phone.
Okay, we're batting 1,000 here. Okay, but I bet you can give me your favorite quote.
I did.
You already did?
Always do right. This will gratify some and astonish the others.
That's great.
Always do the right thing, and this will gratify you. My father told me you have only one resource they can't take away from you, and that's your reputation.
Wow.
And I'll give you one piece of advice. When you're trying to decide whether or not to do something, as a lawyer, you face this all the time. You can do something that's legal, but you don't feel comfortable with it. And I went to my dad the first time with this, and he says, you know the answer. Just ask yourself the question, do you want it on the front page of the newspaper? If you don't care, don't pay attention to your partners, go ahead and do it. But if you do, walk away.
That's great. Great. He was a wise man. Wise man.
Oh, yeah.
And the final one is sort of a hypothetical question here. If by some catastrophic event you lost everything and all you had was $1,000 in the bank, I mean everything else gone, all the assets, everything, you only got $1,000 in the bank, what would you do with that $1,000 to try to rebuild your business?
Well, I wouldn't do anything with it. I'd put it in the bank and go out and find a partner with a couple $1 million and show him a deal that he couldn't turn down. And tell him, get it, try and get it under contract. But maybe if I had to put up $1,000 as a deposit, so I had some skin in the game. But particularly, as you're older, your time is short. So again, I'd say get yourself a partner.
Great. And where do you find those partners?
Well, you find them in all kinds of places. You may even have a relative who's been very successful in real estate investment. Or you can go to a local university or some other group that has classes. Most of the major universities have extension courses, and go and listen to the guys that are lecturing. And either they will have someone, either they will be potential or they'll know somebody.
Great ideas. Well, Samuel, how would people get a hold of you or find out more about your company and what you do? What's the best way for people to find out about Samuel Freshman and Standard Management Company?
Well, there's a couple of sources. One is to go to our website, which is www.standardmanagementcompany.com. That's our website. It has our portfolio and a lot about our philosophy. They can call my secretary, Margaret Swift, at 310-410-2300. Extension 5306, 310-410-2300, extension 5306, and she will send them out that little green pamphlet that you like so much.
Oh, yes.
We don't charge for that. And she can make a telephone interview. Usually you can give them 10 or 15 minutes and see what their problems are. If they actually have a property, she can give them my email, and they can send in a summary of something, and I'll have somebody from the office, one of the underwriters, call them, follow up and see if it's something we might be interested in. As I say, investors are fine, and if they want to invest, they can get on the investor list just again by calling Margaret and telling her what they're looking for. Our minimum investment is usually $50,000, sometimes $100,000, and the preference dividend is usually around 6%. So if they're interested in that, and then we have loans that we do also. They need the minimum loan we make is $1 million. We can go up to 50. So if they need a gap or bridge loan until they get the property ready for going to the bank, we're very interested in that. Person that should be asked to be transferred to the loan underwriter, which is usually Tina Dedarian. So we do two things. We buy property and we make loans.
Oh, that's great. That's excellent. Thank you. As you know, Samuel, we're called the Old Dogs REI Network, and we close out each show with our guest giving us their best old hound dog howl. Now, I don't know, in Beverly Hills, they probably don't have too many hound dogs, so you have to maybe go back to your childhood here or something to get a good idea. Michigan, I don't know how many hound dogs Michigan has, but we're just going to open it up to you to close out our show with your best old hound dog howl. Are you ready, Sam?
Ready.
All right. That was great. I love it. We haven't done one like that, I don't think, ever. That was a good howl. I love it. That was fantastic. Wow. Well, thank you so much, Sam, for joining us. We really appreciate your giving of your time and expertise here, wisdom you shared with us as well. I also want to thank all of our old dog listeners, too, out there for joining us today. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. Now, please note that everything we presented here will be outlined for you and recapped in our show notes, which can be accessed at our website, Old Dogs website, Old Dogs REI Network, and dogs spelled DAWG, olddogsreinetwork.com/blog, and you're going to look for episode 091. And of course, you can also reach us through iTunes, Stitcher, Google Play, and iHeartRadio. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.